welcome everyone to the presentation. I'm joined by Selim Bucher, who is the founder and CEO of not just TaXperts, but you also have another company, right?
That's correct. Yeah, that's correct. The other company is called Exactio AG. I'm a managing partner there as well. There we offer a bit more than just tax services.
Awesome.
Yeah.
And TaXperts, it's important to note, so they do Swiss and US tax. Any other countries involved there now?
At the moment, not. We're thinking about expanding into German tax services, but at the moment, it's Swiss and US services.
Okay, great. So if you're joining us, it's just important just to be aware that Selim and I are not your advisors unless you have engaged us directly. This is general advice that may or may not be applicable to your unique situation. Be sure to speak with your financial advisor, accountant, or lawyer for advice directly related to your situation. A little bit more about me and Selim. So like many of you joining us on the call today, I am a US expat. I've been personally and professionally exploring cross-border tax and financial planning issues for over 15 years. I own and operate Connected Financial Planning, a fee-only financial planning firm. We say fee only because we are only compensated directly by our clients. We do not sell any products. I've written for Bloomberg Tax and been featured on numerous media outlets, including CNN, Yahoo Finance, and Consumer Affairs. Please feel free to connect with me or Connected Financial Planning on LinkedIn and Facebook, where I engage with the broader expat community on tax and financial planning and general expat considerations throughout the week. And Selim, I'll let you introduce yourself a little bit more here.
Yeah, sure. So my name is Selim Bucher. I'm the founder and tax partner of TaXperts. As Arielle already mentioned, we offer Swiss and US tax advisory and tax compliance services. We are a team of 8 people, and our focus is really helping expats and people coming from abroad into Switzerland, having international complex tax situations to help them navigate through the Swiss and also to the US tax legislation. My background is from the Big Four. I've been working at Deloitte here in Switzerland as well as in the US. And all of our advisors have a Big Four background. This is very important for us because 95% of our clients are non-Swiss. So they are international clients. So it is very important that our advisors do have an international mindset and also an understanding of the international tax legislations.
Yeah, I always found that really interesting about your situation, the fact that you actually lived and worked in California, and therefore you've also had to deal with US tax considerations.
Yeah, I know how it feels to be an expat. It can be stressful, especially when you don't know the system. So I can relate to most of our clients that are coming into Switzerland and just feeling lost. So there we really try to support predominantly with tax matters, but we also offer social security and pension services if there is a need.
Great, thank you. So we're going to kick things off today. Like I said before, we have a lot to cover. Selim and I both love to talk about this. I think Selim's been over to my house for a dinner party where we've talked about this. So these are topics that we're really personally and professionally passionate about talking, so we can get lost in the details, so you don't have to. So we're going to run through the Swiss retirement system, US tax considerations, right? That's really why all of you are here tonight, is the fact that we do have to talk about the US tax considerations, which are very unique compared to the rest of the world, because US citizens and US green cards, we have citizenship-based taxation versus residence-based taxation. So it's a completely different system than the rest of the world. We'll be talking more about how to track your pension basis for US tax purposes, what happens when you actually go into retire, right? And you stop making pension contributions, and now you want to take some of the contributions that you've been making for all those years, you want to take that out, what happens there, and then some additional reporting requirements. So if this is your first introduction to the Swiss pension system, don't worry. The concept is very similar to the US system and actually many other countries. So pillar one, it's really like a three-pillar system. Pillar one is essentially Social Security, and it includes survivors, unemployment, maternity, and disability insurance. So if you're thinking about the first pillar, that's very similar to US Social Security. Then we have pillar two, which is the occupational pension, and this is mandatory in Switzerland. The equivalent program in the US would be something like the 401k or 403b. But in Switzerland, this program has mandatory contribution percentages based on the employee's income and also their age. Salim, this is something that I always found really interesting about the second pillar, is that as you get older, your pension contributions, the amount that you have to save, and also your employer, they both go up as you get older. So that's really interesting.
Yeah, that is correct. So the older you get, the higher the contribution rate. And there is a minimum requirement in Switzerland, but most of the employer do not follow that minimum requirement because it's quite outdated and it will not meet the purpose of continuing your current lifestyle with the minimum requirement. So a lot of the employers, they decide to have a additional or an extra mandatory coverage. And I think what is unique or different from the US is that the employer is mandated to contribute at least the same amount as the employee, if not more. So depending on the pension plan that is concluded by the employer, it's also possible that the employer contributes more than the employee. In extreme cases, it's possible that the employer funds 100% of the total contributions.
Oh, wow. Yeah. I mean, we'll get it a little bit more into even talking about the supplementary pension plans that we see, but it's similar to the 401k, but I would say it far exceeds what the 401k does for you.
Yes.
Yes, so
you can basically insure like or have contributions of 20, 25 or 30% of your compensation, which is very high. Which can be very high.
Yep, absolutely. And then we also have the third pillar. So that's your additional individual savings. And it's an optional program. So that's tax deductible in Switzerland, and the equivalent program in the US would be something like the traditional IRA. It's really important to note here right at the start that the US does not recognize the Pillar 3 account and basically treats them like a foreign investment account. So that's our very brief overview of the three-pillar system, and we're going to kind of dig in a little bit more. So just thinking about comparing the Swiss pillar system to the US a little bit more, there's a lot of surprising facts that I've learned since being an expat in Switzerland. The pillar one is really set up for a minimum existence. Now, this surprised me when I learned this because we're in Switzerland and everything is so nice and the cost of living is so high. And I just assumed, like, similar to the US Social Security system, there would be a much higher benefit. So to kind of compare the two plans, in 2024, the max benefit in Switzerland is 29,400 Swiss francs. Now, I can't imagine living on less than 30,000 Swiss francs in Switzerland. I don't even know where you would live. Now,
maybe to add, like, the 29,000 Swiss francs is if you have contributed to the system for 44.
Yes. Oh, and I think you just muted yourself, Salim. But yes, 44 years of contributions to get 29,400 Swiss francs.
Correct.
Now, let's compare that to the max US Social Security benefit in 2024, which was 58,476. Now, that's based on full retirement and full contribution as well. So, I mean, it's basically double what Switzerland gives you. And this shocks me. Another thing that I was looking at is if you look at the inflation considerations or the inflation adjustment, we had a 3.2% inflation adjustment in the US. And then I think it was from 2022 to 2023 when we had really high inflation, the inflation adjustment was 8.7%. So we have this kind of built-in inflation adjustment that really protects retired individuals in the US. We have the inflation adjustment. Now, as far as I can tell, from 2023 to 2024, the benefit amount didn't change at all. So no inflation adjustment either.
Well, there is, but not on a regular basis. So there are inflation adjustments, but not as often as in other countries. Fair to say also that Switzerland did not have that much of an inflation in comparison to the US. So, but there are inflation adjustments, but it's not on an annual basis.
Another thing that I learned is with the Pillar 1, they're like one of the most aggressive tax departments. If you aren't making your mandatory contributions into the Pillar 1 system correctly, they're very aggressive about going after and getting those contributions from you, especially for self-employed individuals.
That is correct, and not only for self-employed individuals, but also, of course, for employed individuals. And the reason for that is because it's an employer's obligation to, first of all, deduct the contributions from the employee, but then, more importantly, to remit the Social Security contributions to the authorities. And the authorities, they know that since it's a basic coverage once you retire, it is important that the individual has enough contributions to get the benefits. So for each employee, it is usually recommended to order like a personal Social Security account statement extract that can be done with any of the Social Security authorities every 5 years, because this way you can make sure that your employer actually remitted the Social Security contributions to the Social Security authorities and that your contributions have been credited to your account, even though you're not necessarily getting the same, or you're not receiving the contributions back, but the contributions are a factor to determine your benefits.
Yep. Yeah, and I will say the one caveat there is if you come here, a lot of US expats come here on an official expat assignment, and that's different, right? Because the US and Switzerland does have a Social Security totalization agreement in place, meaning if you come here on the official assignment, and I know we're going to talk a little bit about this tomorrow night, what is the definition? We don't just say, oh, I'm an expat, therefore I get certain tax privileges. But you can actually, for up to 5 years, when you're on that official contract, you're not localized, you can still make US contributions instead of making Swiss contributions. You would only make contributions to one authority. So that's the one caveat. So then, of course, if you at one point localize and you're here for more than 5 years, then you wouldn't see those years on your report, but you would get the credit from the US and the benefit from the US. Another thing to note with the Pillar 3, so the contributions are pretty similar. The max contributions are pretty similar to the US. So this year in 2024, you can contribute up to $7,000 into an IRA, and the Pillar 3, I think, is 7,056 francs. But my understanding with the Pillar 3 is that you actually have to fully withdraw those accounts by retirement age.
Yeah, that is correct. Well, legislation has changed as of January 2024. And before that, you were able to postpone the withdrawal up to 5 years. So you could wait until the age of 69 for women and 70 for men. Now this is still possible, but only if you still perform a gainful activity after the official retirement age. If not, then, and that's new since 1st of January 2024, you're forced to close down your Pillar 3 accounts or investments and have them distributed.
Yeah, which, I mean, that is so different from the US system where you don't have to do anything with them until now under the Secure 2.0 Act until age 75. And then you only have to take a minimum required distribution. So it's a very different planning for Pillar 3 accounts than it is for IRAs, even though I say they're kind of equal. They're not. They're completely different types of accounts and completely different considerations, but just kind of generally speaking, that's kind of your individual savings.
Yeah. And maybe just
yep.
what is important, because it's important that you mentioned that, especially like the planning, the IRA distribution planning for someone living in Switzerland needs to be planned carefully, because Switzerland does not know such a flexible system in terms of distribution. So the view of the tax authorities here is very restrictive and can be tax disadvantageous from a Swiss perspective. So it's very important to have that reviewed before actually taking any distributions or postponing any distributions, just to make sure that there's not a huge Swiss tax bill waiting.
Yeah, it's such a good point. And I know we'll talk a little bit more about that tomorrow, but it's like you kind of have the scale and you're always just trying to like optimize the scale. But if you optimize too far one way or the other, you get out of balance and then you get surprise tax bills from one authority to or another. So yeah, very good point. So yes, this kind of brings us to we had some major Social Security reform January 1st, 2024. And this goes back to a vote that happened in 2022. Is that correct?
Yeah, I think it was in 2022. So what happened is in the past, the retirement age for women was 64, whereas for men it was 65. Now this has been harmonized. There's a transition period for women born between 1961 to 1963. There it gradually increases the retirement age, and for women born after 1963, the retirement age is 65. So it's the same as for men now. We have to see. My suspicion is that at some point the retirement age will be increased to 66 or 67. So far, there has been no vote around that, but most likely this will be happening soon. The main reason for it is because it becomes more and more difficult to finance the current retirees for Social Security benefits because people are getting older, and the current workforce, the contributions made are not always sufficient enough to finance the current retirees. So that's the main reason why the retirement age has been harmonized for men and women. What also has been introduced is a flexible retirement that is new. In the past, you could retire earlier. So you could retire 2 years prior to the official retirement age, or you could postpone it up to 5 years. But that approach back then was an all or nothing. Either you did retire in full, or you did not retire at all, and you kept working or at least paying into the Social Security system. Now it is possible to have a bit more of a flexible approach, meaning if someone works, let's say someone is 64 years old, wants to start preparing for retirement, reduces work to 80%, then this person can claim Social Security benefits for 20%. So that the income gap is not that significant because the work has been reduced to 80%. So there's this flexibility that you can have a flexible retirement between 20 to 80% of the Social Security benefits. Any early retirement will, of course, lead to reductions of benefits, but it will only reduce the percentage that you take in advance. So if you retire early and you say, I take 30% of my benefits until I'm 65, and then I take 100%, only the 30% of the retirement benefits are reduced. On the other way around, if you postpone the retirement benefits, then you get like a supplement. So you get more once you then retire and ask for the benefits. So this really helps like people to get into retirement. So that's not a drastic change from 100% working to 100% retirement. So they can adjust over the years to yeah, to walk into so-called flexible retirement.
Which I think really reflects the reality that we live in now. Like everything is just so much more flexible. People want to ease into retirement. None of my clients are thinking about, okay, I'm gonna like retire and then never work again. Even people who've retired maybe a little bit earlier are still wanting that flexible lifestyle of like, okay, just, I want to do some consulting. I want to do something and kind of ease into it. So I'm excited that flexibility is in Switzerland now too.
Yeah, and also I think there's also a lot of planning around that, especially now with the flexible retirement and what you just mentioned, like keep having certain like maybe self-employment activity or employment activity. What is important is always that the necessary contributions are made. And they oftentimes, if someone significantly reduces the work time, then it needs to be reviewed under which scheme Social Security needs to be paid, because not in every scenario Social Security contributions are due as a self-employment or as a self-employed individual. It's also possible to pay Social Security contributions as a so-called non-employed individual. And that in certain circumstances can get very expensive for the individual, because the basis of the contributions is then not your income, because there is potentially no income, but might be the assets that you possess. And there the contributions could get quite high and might not be beneficial for the individual to then pursue like an early retirement.
This is another thing that falls onto my like jaw dropped when I learned about this, like people who really want to take full early retirement and how that calculation is actually done. And we have so much information to cover tonight. I don't even have time or capacity to get into that, but that's a great just red flag if you're sitting here thinking, oh, I want to be retired by 55 and still be a resident in Switzerland and you have significant wealth. Talk to your accountant before you do that, because you may be surprised to learn. And again, it's very cantonal specific. There's a lot of considerations, very nuanced. It's a very unique consideration. Talk to your accountant, because it might be worth it just to have a little bit of consulting income and be self-employed and not fully retire quite yet. It might be very expensive to retire. Okay, so we'll get into our Swiss pensions taxable, and this is from a U.S. perspective. When we're talking about this, we're now kind of getting into the U.S. meat and potatoes here. So employee and employer contributions in Switzerland are immediately funded and vested in Switzerland. So that's a little bit different than how it works in the US. In the US, oftentimes you'll have like a vesting period. So it's different in Switzerland. In most cases, your contributions are immediately funded and invested. And so that is taxable from a US perspective. It's important to read the plan documents closely if you have questions about how your pension works or is operated. But in most scenarios, most US expats that I see and work with, the Swiss pension contributions are taxable, meaning you don't get a deduction for your personal employee contributions, and then we have to actually go and include your employer contributions as taxable income. So employee contributions are never tax deductible for US tax purposes. Employer contributions are taxable. And then any income you earned on those pension assets. So oftentimes if you're looking at your pension statement, you're going to see maybe there was some interest income for the year. That would also be taxable and reportable. It becomes really important to track your US tax basis. So actually tracking, what did you contribute? What did your employer contribute? What was any income that you picked up and reported to the US government? That becomes your US tax basis. And that becomes really important when you are changing employers and rolling over your pension account to a new employer, or if you leave Switzerland, or when you go to retire. It's really important that we understand what your US tax basis is. So again, just to kind of like the next two slides are just going to kind of break down how we consider what the Switzerland sees as taxable and what the US sees as taxable. And Selim, feel free to jump in here. So employer contributions, not taxable for Switzerland. They are generally taxable for US tax purposes. Employee contributions are deductible in Switzerland and then non-deductible on the US side. Annual earnings, not taxable in Switzerland, potentially taxable on the US side. Risk insurance, it's generally non-taxable in both countries, but I will say this is also like a flavor depending on your accountant. I've seen some accountants pick up the risk insurance, other accountants don't say it's not taxable. Distributions in Switzerland, distributions at retirement generally, or even like when you're buying a home or when you have a distributable event are generally taxable in Switzerland. And then for the US, it's only taxable if it exceeds your US tax basis, right? Because we've been reporting everything all along. And so it's only taxable when it exceeds that US tax basis. And then additional pension fund payments or buybacks, they're generally deductible for Swiss tax purposes. They're taxable if they're made by the employer. So if they made an additional pension contribution, that would be taxable, just like any other employer contributions, and then non-deductible if it was made by, and I put employer there, but it should be employee. I see that now. Sorry about that.
Yeah, I think what is also maybe good to know is depending on the pension plan, sometimes it's very difficult to distinguish between the contributions, the savings contributions, and the risk insurance contributions. So not all of the pension providers are distinguishing that on the pension certificate statements, and then it is difficult for the tax accountant to even understand what portion of the contributions are risk contributions and what portions are savings contributions. And also the annual earnings, it is correct that those are not taxable in Switzerland at the time when the earnings are generated. But of course, once you take the distributions, those earnings will be taxed as well. So it's I would say, indirect taxation of the earnings at the time of distribution.
Yeah, it's just like the employer contributions, right? All of those at some point, anything that's in that account, it's kind of like how the 401k is for US tax purposes. It's kind of like everything's in there and anything that's happening in the account isn't subject to immediate taxation, but at some point it's all being deferred. And at some point that's going to be taxed somehow, some way by Switzerland. Unless, and we'll get to our unless part a little bit later. So just want to share this like just a really basic example about how you can begin to see the differences in calculating your taxable compensation in Switzerland versus how we calculate it on the US side of things. So in Switzerland, we're seeing that our salary is being reduced by a lot of things. So your Pillar 1, so your Swiss Social Security contributions, those are being removed from your wages. Your employee contributions, that's being reduced. So your total taxable compensation is much lower in Switzerland than when you go to file your US tax return. We start with the same amount of annual wages, no deduction for Social Security contributions, no deductions for your employee contributions. And now we have to include what your employer gave you for the year. So you end up with, over 30,000 Swiss francs of income difference between these two scenarios. And I think it's also important to add that we also have like exchange rate at play. So we haven't even put in the exchange rate for the year, which I just looked at the IRS official. So the IRS does publish official exchange rates every year. You can find them on their website. So I think in 2023, 1 franc was equal to 0.89 cents, 89 cents, 89.9 cents. Yeah. So just basically add another 10% on your US total taxable compensation for the year. Anything else you want to add before we go to the Swiss pension statements?
No, I think I mean that's I think that's a good visualization to see that the taxable basis in both jurisdictions is very different. So we start at the much higher basis in the US. Also, what is missing on the slide, but is that the employer Pillar 1 contribution is also not added as income from a Swiss perspective, and also not from a US perspective.
And I think it's also, I lost my thought there. I'll pick it up in a minute, I'm sure. But yeah, there's so many differences, and then you add the FX rate and it just becomes a nightmare. Oh, I know what I was going to say. Even if you were in a Swiss canton and the tax rates were the same, right? Let's say you lived in you paid an average Swiss tax rate of 30% on the Swiss side, and then an average US marginal rate of 30%. The reason we see a lot of times our US clients owe additional tax is because, yeah, sure, it's 30% across the board, but you had so much less taxable compensation from a Swiss perspective. So 30% on 84 versus 115, you just have less foreign tax credit. You don't have enough foreign tax credit. And that's where we start to get into more of the advanced planning. Okay, so now we're going to run through a couple of actual pension statements so that you can kind of see what we're looking at and just get familiar for what you should be looking at. And if you aren't aware that you should be collecting these, then this is your note that you need to be collecting these. So like Selim mentioned earlier a little bit, every pension statement is different. Every pension statement is a snowflake. Each one is very unique. So, and often this document is in English, but often you're going to receive these documents in German, French, or Italian, depending on where you live. And I really liked this statement, which is why I grabbed a screenshot of it, because it actually shows the beginning of year retirement assets and the end of year. So I know it's probably pretty small on your screen, but you can see end of year about 156,000 Swiss francs, and the beginning of year 136,000 Swiss francs. This statement also, on the second page, you'll see that it has the breakdown of contributions from the employer and employee side of things. So we get a lot of detail. We get the savings component, the RICS contributions, the legal contributions. It's a beautiful statement. I wish all statements looked like this, but they don't. But this is a good example of a nice pension statement. Anything to add, Selim, before we...
No, but I agree. For US purposes, this statement is perfect because you can pick up all the numbers that you need, and also that the earnings are shown separately. That's also not always the case. Maybe
Yes.
one thing to add: it does not necessarily have anything to do with the taxation, but the projected benefits in retirement. I think there we get a lot of questions from clients because they are a bit confused. What are the projected benefits? And just to maybe give like a brief explanation, what the pension fund is doing is they extrapolate your savings or your contributions until you reach retirement age and work with the estimated return on investment per annum. And now in that scenario, they calculated with a projected interest rate of 2%. And as you can see, the actual interest rate that was applied now from 2021 to 2022, or the return on investment that has been achieved, is 7.59%. So significantly higher than what has been projected. So I think it's very important to understand that these projected benefits need to be reviewed with caution, because the end result could be very, very different, could be significantly more, but also could be lower. Because based on the minimum requirements from the federal authorities, the return on investment needs to be at least 1% in the pension fund. And which is, of course, can be significantly lower than what you would achieve with an investment in the market. And even though your invested funds achieved more, the pension plan provider only needs to give you 1% if there is reasons why they cannot give you more than 1%, even if they have achieved more return on investment with your own funds. They're not mandated to give you all of the return on investment. So it's an indirect. So for pension plans or pension fund providers who do not perform so well, it's an indirect way to finance the current retirees by skimming off some of the return on investment of the current workforce.
That's a really great point. And you're absolutely right. I have literally looked at hundreds, if not thousands, of pension statements at this point in time. And a lot of times I only see like 1% interest or maybe 2% interest. And so they are really, there's really good pension plans and there's terrible pension plans and there's
Yeah,
everything in between. Yeah, great point. So we're going to look at another pension statement. So this is actually what we call a supplementary pension statement. So many senior staff members have a additional supplementary pension plan. And many people, many expats that I know, they don't even know they have this plan because these are documents that we need for US tax purposes. These are not documents that anyone needs for Swiss tax purposes. So you may have like a vault at work and you're getting a statement once a year and you don't even know that it's on some internal mailbox or drive. Until you go to change employers and you go to roll over and they hand you like 2 or 3 or more pension statements. And we're like, what are these? We had no idea they even existed. So if you are a high earner, you're an executive, be sure to double check to see if you actually have a supplementary pension. These are very, very, very common. I have a client with multiple supplementary pensions. It's very common. So you can tell here that this is a supplementary pension plan because there is no employee contribution. So that means your employer is just opened up a secondary pension for you and they're just putting money in this. Because again, from a Swiss tax perspective, this makes a lot of sense. This is money that you are not going to have be immediately taxed on. This is all tax deferred income. So from a Swiss tax planning perspective, this makes like a great way for them to incentivize their highly compensated or senior executives. So if you only receive this pension statement for whatever reason, this is your clue that you're actually you have a main pension plan. So you need to also track down that document for your tax preparer. And again, when you change jobs, you're going to roll over all of your old employer pension plans into your new employer. And that actually is mandatory that you roll over everything over. It's not like the 401k where you can just keep, 5 401ks open in the US. You do actually have to roll over. Anyways, that's generally like a good idea, especially for US citizens, because Swiss financial institutions, banks are not set up to serve US citizens. And so if it just sits there, it's just sitting there in cash, no interest, nothing is being done. And so it's actually recommended to just make sure you go ahead and make sure you roll that over.
Yeah, and I think what is maybe also good to know for supplementary pension plans, there oftentimes the employee has a bit more control over how the funds are invested. So in a basic pension plan, it's usually the employer who makes investments decisions. So maybe the employee can decide on like a plan A, B, or C, and then there's like some investment allocations, but that's usually it. But with supplementary plan, those so-called 1E plan, there the employee has more control over where the pension fund savings is invested. If the employee is not making any election, then yeah, the pension plan provider will just choose on behalf of the employee. But it may be worth to investigate that to see um, if those funds are invested the way the employee wants it, and also take that into consideration for the entire financial planning. I think that's where you can help, like finding out like are the pension funds or the 1E plan are they invested based on like the risk appetite and the risk profile of the individual.
Yeah, that's a great point. Because when we are working with US citizens, we've got funds in Switzerland, funds in the US, and sometimes funds in other countries. And so we're trying to consider all of those and then figure out how are we doing optimal asset allocation. Great point. Okay, so this is your loan housewife, something that you have likely received in the mail, hopefully, or is on your employer portal to download. This is basically your Swiss equivalent of a W-2. And so when you're gathering your documents to file your tax return and you know you have a Swiss pension, you want to make sure that you have your current Pillar 2 pension statements. If you're working with a new accountant, you've just, or your pension statement doesn't show the balance from the previous year, sometimes it's a good idea to also collect the previous pension statement so you can give your new accountant two, so they have like a starting point of how much did the plan actually grow. And then we also need your loan house WISE. So on line 9, that tells you what your Pillar 1 contributions are. So in this case, around 14,000 francs. Line 10.1, that shows your Pillar 2 contributions that you made throughout the year. And then line 10.2, that would indicate if you made any Pillar 2 buybacks. So again, on your pension statement, you're going to there's generally a line saying, okay, especially if you move to Switzerland later in your career, you have the opportunity to make buybacks into your pension plan. And so you would see this on that line 10.2.
Yeah, that is correct. So line 10.2 is for pension buybacks that are done via the payroll. But oftentimes buybacks can be made outside of the payroll cycle. So directly like with bank transfer into your pension fund. And in that case, it typically will not show on the salary certificate, but a separate confirmation statement will be issued by the pension fund provider. And the pension buy-in report in 10.2 is also if the employer made a buy-in, because it will be added as income on line 3 or line 7, and then it will be deducted again, because as we saw earlier, employer pension buy-ins are not taxable.
And Selim, is there anything else or any other clues on this pension or on this salary statement that you would be looking for?
From a pension perspective, no. I mean, the line 10.1 is already a good indication of the employee contributions, but it doesn't provide any details. So we don't know the risk components, the savings components. We don't know anything about the employer contribution. That's why it is very important that together with the salary certificate, also the pension statements are provided to calculate how much needs to be added for US tax purposes.
Yeah, and that's such a good point. So it's really interesting to me. On this loan housewise, there's no indication of what your employer contributed. None. You need to have the pension statement to get that information and to get that further breakdown if it's available. And again, these statements are not written for US taxpayers. They're written for Swiss, employees. So it's a bit of a little sleuthing investigation for each statement. So let's get into like calculating your US tax basis, which again becomes very important. If you're working with a preparer like the TaXperts, they have a US tax team. They specialize in expats living and working in Switzerland. And so they're going to actually know how to track your Swiss pension basis and do that correctly when you're filing your US tax return. If you are working with a US-based preparer, and I see this a lot, your family has always worked with the hometown CPA in Idaho, and you want to keep working with them, and you're the only Swiss client, that's oftentimes a red flag for me because they likely have no idea how to look at these documents or even to understand if they're missing documents. And then if you're self-preparing, I do have some brave souls that I know who do self-prepare their information, then it's really on you to calculate this correctly and track this correctly. So we're looking at the end of year balance. So that would be end of year. So we just finished 2023. So the balance on 12/31/2023, the beginning of year balance, January 1st, 2023, you subtract out the beginning of year balance, your employee contributions, and then you get your total annual employer contributions and growth, because you're not always going to get a separate line item that shows what the interest was during that year. Anything else to add there?
No, I think you summarized it perfectly. I think that's in principle how it is calculated. Of course, every pension plan may be a bit different in terms of like risk contributions that needs to be factored in terms in the employee contributions that are also backed out as well. But that's how we also calculate the annual employer contributions and the growth and earnings in the pension fund to add it for US tax purposes.
Okay, great. So again, it's very important that you keep good records. So employer contributions are included as taxable income on your US tax return, which means you've already paid tax on that. Employee contributions are not deducted. Again, you've already paid tax on it. Annual pension earnings are included as taxable income. So when you're reporting that, you're paying tax on it. So we really want to make sure that we track all of this, because we don't want you to pay tax on it again. That's why this is very important. And what I see a lot, and maybe you see this as well, a lot of US expats come over here on assignment. They're given Big Four tax support, so PwC, Deloitte, EY, whoever your company is working for with at that time. And so they may do this. You are off of your expat assignment, you find out how expensive they are, and then you go and you switch preparers. So it's really important that if you're switching preparers at any time, you make sure that the amount that that is your US tax basis, that's clearly been tracked. So again, it's a clean transition from one tax preparer to another tax preparer.
Yeah, I think that is essential. I mean, a good tax accountant or tax preparer would ask for the basis of the pension funds that has been already considered in the US return, even though the tax preparer has not prepared the prior year returns. It is very important that the new tax preparer is aware of how the basis has been calculated and what the basis is, as you say. Otherwise, there's a risk that pension fund contributions are taxed twice.
Yeah. Okay. And, I didn't ask you about this before we got on this presentation, so I'm going to put you on the spotlight a little bit. But I'm curious if what does TaXperts do? Do you provide a client letter where you break out what was reported, or do you just do kind of a separate line for the employer pension contributions? What does your firm do?
Yeah, so we don't have a dedicated we have a dedicated paragraph around pension contributions and how the reporting principles are, and we track those separately in a client worksheet. In the tax return, we have a separate line for the contribution, so it is transparent. And whenever the client wants to understand the details, we will provide those details upon request. We know that a lot of our clients, they trust us enough to know that we know what we're doing, especially because we not only offer US services, but we also offer Swiss tax services. So we know the Swiss Social Security and pension system inside out. So our US CPAs, they are working closely with our Swiss experts. So from that perspective, our clients, they know that they don't need to double check what we're doing. But if they want, we provide them with the worksheets so they can review if and how it has been done.
Yeah. And from my perspective, anytime we can go back and we can clearly see there's a separate line entry, that makes kind of the sleuthing of figuring out what your basis is. It's a lot easier than if all of your income was just put together on one line. I mean, then that becomes a nightmare because, again, we have different foreign currency considerations each year. So it can be quite an exercise to try to unwind that if you've never looked at it before. So now we're going to talk a little bit more about taxation at distribution. So again, this is becomes where planning is really important. And where you're a resident when you withdraw your pension is also really important. So one of the things we commonly see is distribution of your Pillar 2. So that's your main employer pension contribution when you're permanently departing Switzerland. So from a US perspective, if you've been reporting your contributions all along, you could walk out of Switzerland with no additional US tax liability. If everything's been reported and you have like full US tax basis in that plan. A common misconception is because it's a retirement plan that you can just roll that into a US retirement plan, and you can't. It's your cash. You can do with it what you will. You can buy a house, you can put it in a brokerage account. It's your money. You're fully distributing and closing out that Pillar 2 account in Switzerland. You can also, if you're taking a distribution of your pension and you're no longer a Swiss resident, there's going to be some withholding when you take that distribution, but you can actually claim that withholding back under the US Swiss tax treaty because you are
And I
not
think
going to be
that's a
subject to
very,
double taxation.
yes, and I think that's a very important point that you make. And there's a lot of misconception out there, and especially if U.S. taxpayers speak to non-U.S. taxpayers, the rules can be very different. What you said is correct, that based on the Swiss-US treaty, if you are at the time of distribution, you're no longer a Swiss tax resident, but you are a US tax resident, then based on the treaty, the US has taxation right. But because you have already paid taxes in the US on that distribution, as you say, there might not be a US tax due. On the other hand, the withholding tax that is deducted can be claimed back from the Swiss authorities. So what we see a lot of times is that client, they come to us, they don't know that, and then they start to, they know that they might not be taxed in the US, and then they want to start optimizing their Swiss tax by moving their funds into different cantons and then having the distributions from there, which can all be done, but at the end of the day, it will just lead to a lot of fees and no real tax optimization, because the real tax optimization is to claim back the withholding tax. So you can have the distributions from any canton. It can be in the highest canton or the canton with the highest tax rate. You can still claim back 100% of that withholding. So that's important to know that before taking a distribution, you should really inform yourself what are the tax implications, and also in case you do not relocate back to the US, but you go to a different country, let's say you go to Spain or you go to Denmark or to Singapore or to China or to India, then the double tax treaty between Switzerland and that respective country is applicable. And there the tax treatment may look different. So it is then possible that you cannot claim back the Swiss tax, and then it's possible, or then it makes sense to optimize your Swiss tax.
Yep. I can't believe we're like 6 minutes to the top of the hour. So I'm going to try to run through the last couple of slides. I will send a copy of the slides to everyone who is registered for this presentation. So you'll get a copy of it in your email probably tomorrow morning. So you can kind of use it as a resource. And I think we're not going to quite finish all the slides, unfortunately. So you'll be able to kind of look through those. And if you have questions, feel free to reach out to Selim or I. So another way to take it is to actually annuitize your Pillar 2 at retirement. And then you would recover a portion of your US tax basis with each payment. There's a calculation that needs to be done annually. If you're a Swiss resident still, Switzerland is going to tax you at that point because you've never paid tax to Switzerland and you are a Swiss tax resident. And this is where, but there's a treaty in place. but it's a tax timing difference. And this can be really a burden for a lot of US citizens who end up retiring in Switzerland, is you have to now pay Swiss tax, and you may have been paying US tax all along. And so suddenly you have foreign tax credits from Switzerland that you can't use necessarily on the US side. So it's there's potential for double taxation here. And then lump sum at retirement, again, there's more favorable tax regime from Switzerland, just depending on where you're actually located. And so that could be something to consider as well. Just to kind of, we'll run through this very quickly. There is a lot of additional US tax reporting that you should just be aware of. So Pillar 1, no reporting is required while you're working. Again, that would be reported as like Social Security when you're actually receiving benefits, and that would be reportable. Your employer pension, that's generally reported on the Form 8938. So that's the statement of specified foreign financial assets. That form is actually part of your federal tax filing. And then we have the FBAR. There's been some debate about whether you should report this or not. I've just always reported it. The FBAR is filed with FinCEN. So that's where you file all of your foreign bank accounts. If you had more than $10,000 at any time during the year, you file that with FinCEN. The Pillar 3, again, that's generally reportable on Form 8938 as well, the FBAR as well. And then because the Pillar 3, you can generally pick the investments, most of the time, those investments are what we call PFICs, which the important point to note there is they are taxed punitively by the IRS, and they are a pain to prepare. So your preparer is going to charge you a lot to file those. And so any tax benefits that you may have had by having this account can very quickly, any like fantastic growth that you were promised in this account, all of that is very quickly eroded by taxes, US taxes and filing fees. So proceed with caution there. A couple of clothing thoughts here. If you only do one thing after this presentation, track what you report, make sure you're interview your preparer again and make sure they're actually doing this. It's really important, especially if you're using, a small local preparer in the US. Be sure to double check that they know what they're doing. There's a lot of, you don't know what you don't know until it's too late. Again, your situation is very unique. Well, it's Pillar 2 buybacks and Pillar 3 contributions don't make sense for the majority of US expats. There may be certain cases where these contributions do make sense. I do have clients who have Pillar 3 accounts because they need to have them to get a house and to get a mortgage. And we have those in cash. So there are, every situation is really unique. Gather the right documents. We looked at some of those pension statements. Be on the lookout as you go through your 2020, well, we're in the 2024 tax season. So that's the tax year 2023. Be on the lookout for the right forms, and your preparer should send you an organizer. I will also attach, we've put together a little US tax checklist for expats. I will attach that for you in the email that I send out tomorrow with this presentation, so you can have that as a resource as well. Anything you want to add, Selim, before we shut this down for the evening?
No, I think the closing thoughts that were spot on. I think it is very important that you track your pension contributions, speak to your preparer if you are not certain that this has been done correctly in the past. There's always ways to correct it, so it's never too late. So it's better to have it corrected than just to keep doing the wrong thing. Also, as you say, in general, Pillar 3A contributions, pension buybacks do not make sense, but there are circumstances where it makes a lot of sense, especially for expats coming from other countries with very high taxes. As an example, if someone is coming from Germany and has unused tax credits, then potentially pension buy-ins do make sense. And if you do not get the proper documentation from your employer, there's always a possibility or an option to contact the pension plan provider directly, and they should be able to provide you with the pension certificate statement. I mean, most of the pension plan providers, they also have an online account or online portal where you can upload, where you can download these statements, these annual statements.
Yep, that's a great point. Okay, so Selim, we are back tomorrow night. We will be getting into it again with getting organized for your Swiss and US tax filing. And so I'm really excited to chat again about more US and Swiss tax issues tomorrow. If you have questions again, feel free to send us an email. And we hope to see many of you guys tomorrow night. Have a great night. Thanks so much for coming out. Thanks,
Have a
Selim.
good night.